We're not started yet. We're going to start in just a moment. But everybody should have one of these crazy charts of random numbers. And if you would, just put that aside for a moment. We're going to look at it in a few minutes. And Mark, you tell me when to start. We ready? Okay, we'll go ahead and start. My name is Bill Williams, and this is about Chaos, a new map for traders. Have a lot of material to share with you. If I get to talking too fast, which I have a tendency to do, just raise your hand and tell me to slow down, this kind of thing. First of all, what we want to accomplish in this 90 minutes is I'd like to share with you some of our research and some of the underpinnings of chaos. And more than that, I'd like to share with you how it works in the market. If you're interested in the actual research, which is very laborious and very detailed and very boring for most people, we'll be happy to share it with you, but there just isn't time to share that with you here. So I think it'd be more beneficial, and I hope you agree, to share some techniques of how it's used in the market as opposed to how we came to where we are. First thing I'd like you to do is just look up there and tell me what you see on the first two lines up there. Ambivalence, okay? Most people who look at that, the vast majority of people who look at that, say that opportunity is nowhere. Every now and then you'll find somebody who says, no, it doesn't say that at all. It says opportunity is now here. And the point is that the stimulus does not make the difference. The thing that makes the difference is the programming that has been done that you're unconscious of. And the programming is another way of saying your paradigm. And your paradigm is the way that you look at the market, the way you look at yourself, and the way that you look at everything. It's the glasses that you look through. For example, if you could take 3 different pictures of my body. You could take a Polaroid picture, it would show you one thing. You could take an X-ray picture, it would show you something very different. Or you could take an infrared picture, and it would show you still another difference. So the difference is not my body, but the difference is what you're using to photograph it with. And the same thing is true with the market. And the theory of chaos, or the science of chaos, gives us a interestingly new and profitable map to look at this. Now, first of all, chaos is not new. Chaos, the 15th century mathematicians were talking about chaos. I bought my first book that had the name Chaos in it in 1967. But it was only about the middle of the 70s with the Cray super mainframes that we got to the point where we could handle the non-linear feedback calculus. And that's where chaos came in. It is effective. It is proven effective both for us personally and for other people who are using it. This is a reprint out of Futures magazine, the December issue. There were 2 guys who got together, Charles Parker in Houston, Texas. Charles Parker, who was an attorney, and a computer guy by the name of Steve Winland. And they started a fund, an offshore fund, last year. And in the December issue of Futures magazine, they were ranked #1. Now, in the current issue of Futures magazine, if you got one out there or if you subscribe, if you look at this same page, they are #1 this month, which makes me very happy because they're using chaos. Now, let's look at a couple of things that I think are very important. And, oh, here it is. And that's what we started talking about at lunch today, and that is that we have an interesting setup here. And the setup is that you are in the top 10 percentile of intelligence. Low intelligence people aren't attracted to trading commodities. And the second thing is that most of you in here, probably all of you in here, have been very successful at other things. So put those 2 things together and you come out with 90% losers. Now, if you're a plastic surgeon and you lose 90% of your patients, you're not going to be in business long. And notice that whenever you talk to, I don't know if we have any medical people in here or not, but I have a lot of friends who are in medicine, and my wife used to be on staff at the teaching hospital, University of Miami Med School. But, you know, doctors, one of the interesting things about professionalism is that the higher up you go in the ladder, the more ways you can pass the buck. So a doctor never says, I killed my patient. You never hear them say that. I've only heard one say that. What the doctor says is the patient went bad. It wasn't my fault. You know, they lost the will to live. If you're an attorney, for example, you can get out of a lot of stuff by saying, well, the judge was crooked, if you lose the case. If you win the case, of course, I was a brilliant lawyer. But if you lose the case, well, the judge was bribed or the jury was ignorant or something of this sort. And we psychologists have really the lockdown on this. So I can tell you that it's really not good and it's not kosher, and I hate it, but every Saturday night I have to beat Ellen up. I abuse her a little bit, but you see, it's not my fault because my mother toilet trained me too soon. So we can get out of that. Now, the nice thing about trading commodities, I think, is that there's no way to pass the buck. At the end of the day, if you've lost money, there's absolutely no one to blame.
Well, bad luck.
Bad luck? Well, yes, you can blame bad luck, but there's not really anybody you can blame because you made the decisions, you made the trades, and you lost. The other side of that coin, which I like a great deal, is that if you win, you also don't have to say thank you to anybody. You made the decisions, you made the trades, you made the profits. Ellen wrote an article about this once where she described commodity trading, and this is the best description I think I've ever heard. She describes commodity trading as sliding down the razor blade of life, which I think it gets your adrenaline up and gets things going, and it's an awful lot of fun. Your paradigm is very essential to the way you look at the market. And you don't think about your paradigm, you don't think about these glasses you look through, you think from them. And when your paradigm changes, your whole world changes. And if you're in the wrong paradigm, you can do absolutely the right things, but the wrong results will happen. Let me tell you a true story. Since we're out here in Los Angeles, near Beverly Hills and Hollywood, there's a Hollywood movie actor whose name you would recognize immediately if I said it, who has a cabin way up in the hills. And he also has a Porsche 911 Targa convertible that he likes to zoom and go up the hills. And every Friday afternoon for therapy, after a week of shooting, he gets in that car and he zooms up to the hill. Now, there's very few people who live there. And those people who live there, there's even fewer visitors. So he almost never, ever meets anybody going up that road. Well, this one Friday afternoon, he's zooming up there, and on one side of the road, there's a cliff. And he comes around this curve, starts around this curve, and a car comes careening around the other way. And it's in his lane, and he uses all the braking power his Porsche has and stops, and the other car stops in his lane nose to nose with him. And in the other car, it's also a convertible, there's a good-looking blonde. So she backs up a little bit, turns around, and passes him, and as she passes him, she looks at him and points her finger at him and hollers out, "Pig!" Well, he's sitting there, and he's getting a little teed off because he's on his side of the road. He wasn't doing anything wrong. It's her fault, and she calls him a pig. So he very quickly responds out of his paradigm and shouts back at her, "Sow!" And then he gets mad. And when he gets mad, he floorboards his Porsche and zooms around the curve where he immediately runs into a hog. And she was trying to save him, and he thought that she was trying to criticize him. His paradigm changed that quick. Now, the paradigm that chaos gives us is three things, and this is in your notes on the second page, which is at the top of page G4, GG4. There are three things that the science of chaos gives us, three principles. And I think that physics in the 20th century is going to be remembered by three things. It's going to be remembered by the theory of relativity, number one. It's going to be remembered by quantum mechanics, number two. And number three, it's going to be remembered by the science of chaos. And your life, your personal life, and my personal life is going to be much more affected in the next 10 to 20 years by the science of chaos than it is by relativity or atomic fission or anything of this sort. The theory of chaos, and the reason it's important, is that classical physics, as we know it today, basically only deals with man-made objects and man-made behavior. There are two areas that classical physics just simply does not have any ability to deal with. And those two areas are, number one, turbulence, and number two, living systems. Now, if the market is anything, it seems to me that the market is living systems existing in a turbulent atmosphere. Now, a great deal of the research in chaos has been done in medicine and meteorology and economics and now psychology. In medicine, it's changed a great deal of our thinking. For example, when the first artificial hearts came out, they were mechanical in nature, and everybody died. And the reason they died is that the heart is not motivated by mechanical electrical impulses. Those impulses are fractal in nature. And when they started with the pacemakers on a fractal basis, then mechanical hearts and artificial hearts worked for a much longer time. You have to have chaos in your life. You have to have chaos in your heartbeat. You also have to have chaos in the market. Now, chaos does not mean what we normally think of as the connotation of chaos. And we humans have a tendency to misname the things that are most important in our life. For example, right now, you're listening to me through a part of the brain that we call what? What do we call this thing you're thinking with right now? We normally call it the conscious mind, don't we? But that's the only part of our brain that ever sleeps. So if we were accurate, we would at least call it the part-time conscious mind, or the sometimes conscious mind, or the paraliminal conscious mind, or whatever. But it is not the conscious mind. We also, if you understood chaos in detail, and you wanted to throw people off base, you wanted to give it a name that would absolutely throw people 180 degrees off base if they didn't know anything about what you were talking about, what you would call it is chaos. Chaos is not randomness. Chaos is a much higher form of order. For example, back to your heartbeat. If you have a very regular heartbeat and something else doesn't happen before, like an accident or something, you're going to die of congestive heart failure in your left ventricle, because that's what causes it. If you have very regular brain waves, you're going to have an epileptic seizure, because that's what an epileptic seizure is. It's very large coordinated sine wave brain waves. And normally, if you're not having a seizure, your brain is very, very chaotic. And one of the classical physics problems is light a particle or is it a wave? Is a photon a particle or is it a wave? Is an electron a particle or a wave? And the answer is basically it depends. One of the things that classical physics assumes is that you make stuff out of stuff. So if you're going to make stuff, you've got to go get some other stuff and make stuff out of stuff. One of the things that quantum mechanics gave us was that stuff comes from non-stuff. Now those are very, very scientific terms, but you understand what I'm talking about. For example, one of the classical things in high school physics, if I were a high school physics teacher, Grant, I might ask you to come up here and get me the temperature of that water. And Grant would probably go over to the lab table and get a thermometer and stick it in there, and immediately I'd fail him because he didn't do what I asked. What he's telling me is the temperature of that glass of water with a thermometer in it. That wasn't what I asked for, was it? I asked for the temperature of the glass. And he put the thermometer in it and messed it up. Now, it may not make any difference, but at the quantum level and at the level of reality in the universe and the subatomic particles, it makes a whale of a difference. So in subatomic physics, for example, if you're looking at an electron through an electron microscope, you make it look like a particle because you look at it. The very act of you looking at it makes it appear to be something else. If you look at it through this electron microscope, it looks very much like a particle, but the instant you turn your head, it's no longer a particle. It's now a wave. This is very confounding to classical physics. And the counterpart in the market, of course, is a bracketed market and a trending market. Everything we have, living system, operates this way. For example, you're looking at me right now, and on the retina of your eye, in the middle of that retina, there's a place or an area called the fovea, F-O-V-E-A. And that has little prongs that go right into your brain that only record color, nothing else, only color. On the outside of your retina, there's another area that only records waves. So this records particles, this records waves. And then it goes through the optic nerve into the association center, and you put those things together, and you think you're seeing me. You're not really seeing me, you're creating me. Same thing happens in the ear. When you go into the ear and you go into that cochlea, those little hairs in there, each of them vibrate to a different frequency. So you have one, if you hear middle C, will vibrate when you have 250 cycles per second. You have another one that vibrates at 257 cycles per second. Then your eardrum takes the wave, and then it goes together, and you put this together and recreate reality. In a similar way, chaos takes the market apart into particles and wave structure, not Elliott wave structure, but the wave pattern, and then puts it back together in a way so that it creates reality in a different form than we normally recognize it to be. So, classical physics has some limitations, and the science of chaos has been specifically designed to measure natural systems. The two areas that classical physics does not have any real power in at all, again, is living systems and turbulence. The origin of all this science of chaos began actually on D-Day, on the invasion of Normandy. And the reason for that was it just happened to be accidental, that the weather cleared and made the invasion much more a success than if it had not cleared. Then the Pentagon got involved and they said, man, what we need to have for strategic purposes is long-range weather forecasts. And they put the first money into it, and the first money went to MIT, to the meteorology department in MIT, and then to the IBM Research Center in Yorktown, New York. Some of the earlier people were a guy by the name of Lorentz, another guy by the name of Benoit Mandelbrot. And one of the things that classical physics cannot do, for example, is classical physics cannot measure randomness or irregularity. And in chaos theory, there is no such thing as randomness. There's regularity in all irregularity. The only thing that we call random are things that we don't understand. So if you were to go out here, for example, and say you're going to measure the coastline, the length of the coastline of Southern California, it's an impossible task using Newtonian Euclidean kind of measurements. If I sent you out there with a 16-foot surveyor's rod, you'd come back and say, well, it's so many kilometers, so many miles. And I'd say, no, that's not good enough. And you're working by the hour, so it doesn't matter. So I say, I want you to go out there and measure it with a yardstick. So you go out and measure it with a yardstick, and you say, no, it's not what he said. It's a lot longer than that. And then I send Bob out there with a 1-inch ruler. And Bob comes in and says, no, both of you are wrong. It's a lot longer than that. So we have, as you get finer and finer in your measuring instrument, the length gets longer and longer. So you have that paradoxical kind of thing, that you have something with an infinite length in a finite space. And classical physics cannot deal with that. Mandelbrot had an idea. His idea was that you can deal with it, and again, this is not a new problem. This came in the 1500s, or in the 1400s in the 15th century mathematicians. Here's what they said. If you have a dot, that has 0 dimensions, right? If you have a line, that has 1 dimension. If you have a plane, that has 2. If you have a solid, that has 3. Now, here was their conundrum. Here was what the theoretical mathematicians at the time Columbus invaded America, that they came up with. You have a curved line that's still 1 dimension unless it closes up. What if you had a rectangle here, and you had a very curvy line that never crossed itself, and it came down through here, and much more than I'm drawing it, but it shaded 50% of that rectangle. What's the dimension of that line? It can't be 1 because it shades half the rectangle. It can't be 2 because it doesn't shade 1/2 of it. So for centuries, that has been a theoretical math conundrum. Mandelbrot solved that problem very simply. He said that the dimension of that line is 1.5 because it covers half of the space and leaves half open. So he uses this chaos, or fractals are a measure of irregularity. So what Mandelbrot did, he started studying this irregularity. And one of the early things he did when he was working for IBM was to find and define the fractal of the Mississippi River. Well, the fractal of the Mississippi River happens to be 1.2610 to 4 decimal places. You can carry it out further than that, but that's as far as we need to go. And that means that the Mississippi River, the curvature of the bank of the river and the curvature of the river is such that if you outlined it with a channel, it would cover up approximately 1/4 of that channel. Then he said, well, let's check it out. So then he measured the fractal number of the Tennessee River. And guess what he found? The fractal number to 4 decimal points was exactly the same. Then he said, well, let's try the Ohio River. Did that. Guess what he found? It's the same thing, 1.2610. Then this was about 1980. And the management of IBM, although they did not do enough to change it, they could see the handwriting on the wall, and they came to him. And by the way, Mandelbrot is a maniac researcher, and that's a compliment. I mean, he's one of these kind of guys that just gets onto something and doesn't leave it. I happen to know a person who Mandelbrot was the head professor on his PhD program in theoretical math. And one of Mandelbrot's characteristics is that he believes his circadian rhythm is not 24 hours, but it's 25 hours and 10 minutes. Therefore, he goes to work every day 1 hour and 10 minutes later than the day before. So on Monday, he goes to work 3 hours and 30 minutes later than he did on Friday. Now, to get paid what he gets paid by IBM, and to have those kind of hours where every so many days you're showing up at night instead of the day, you got to be good. You can't be a civil servant here. So they came to him and they said, look, all this work you're doing is great. It's called pure research, and pure research simply means that once you get the answer, you don't know what the heck you're going to do with the answer. I mean, it has no practical applications necessarily. And they said, we would like to be a for-profit company. We always have been. We'd like to continue that. And is there any way that you could kind of direct your research in a slightly different direction so that somewhere down the line we might make some money out of it? And Mandelbrot thought, well, that's an okay idea. So his idea was, first of all, to apply it to economic stuff, then to apply it to physiology, which is medicine, then to sociology, and then to psychology. Now, at Yorktown, the thing they had most in their library, in their research library, in the way of historical data, was they had some long-term cotton and corn prices. Open, high, low, close were on a daily basis that went back a long number of years, 100 years or so, through 2 world wars, through all kinds of droughts and depressions and famines and everything else. So he put the fractal analysis onto the corn and cotton. And guess what he found? The fractal number for corn and cotton to 3 decimal places is exactly the same as the Mississippi River. Now, when I heard that, I did not sleep a wink that night, because that was like the curtains opening. Because what that said to me, that the markets are a natural phenomenon. They're not a man-made phenomenon. They're not economic. They're not fundamental. They're not technical. They're not mechanical. They're natural. Question? Yes?
Would you explain what a fractal is?
I'm going to, yes. But I'm going to tell you what a fractal is in the market so we can trade it. Basically a fractal is a change in behavior. So when you decided to come into this room rather than go into another room, that was a fractal. When you get out of a trade, for example, when you get out of a losing trade, there's always a very, very, very specific fractal that will tell you when to get out of that trade. You will always get out of a trade when the pain of losing $1 more is more painful than saying you were wrong to take the trade. So as long as the pain of saying you were wrong is greater than pain of saying I don't mind losing another $1, you'll stay in there. But when that $1 gets, I can't stand it anymore, then that's a fractal and you'll get out. So one way to think of a fractal is a change in behavior. For example, let's take this. Let's say that you have a market that goes up like this, okay? And you put a channel around that market like this. Then you have another market that goes like this, and you put a channel around that market. Well, those 2 markets are very different markets. Now, the one on the left will have a much higher fractal number. And what really happens in the markets is that you will have a market that's going up here, and when it reaches the apex up here and starts down, and that's the point we're always looking for, is that change in trend, the fractal number will be the highest. It will be on the average, and then it'll jump up, and then it'll turn around. So the fractal number going up is an anticipatory signal that the market is about to change its mind. It's about to relieve its pain of going up, and now it's going to relax and go back a little bit. Now, what on that page, what did we just say? 4. On page 4, GG4. What the science of chaos has given us is 3 principles that are applicable in the market. The first principle is that everything in the universe, your shoes, your toenails, your market orders, everything in the universe always follows the path of least resistance. So when the market goes up, that's the path of least resistance. When it stays the same, that's the path of least resistance. When it goes down, that's the path of least resistance. The reason you're sitting where you're sitting right now is because when you came in here and other people were going around, that seat happened to be the path of least resistance with all your motives going at that point. Second principle is that this path of least resistance is determined by the always underlying and usually unseen structure. The path of least resistance is determined by the always underlying and usually unseen structure. Let me give you a couple of examples. let's say you have a river running down the mountain. Now, the behavioral decisions that that river makes depends not upon the mind of the river, but it depends upon the riverbed. So if you have a riverbed that's shallow and narrow, that river is going to be going down in rapids. If you have a riverbed that's wide and narrow and deep, you're going to have a calm pond. So if you want to change the flow of that river, you can get down there with buckets and try to do it and get a bucket brigade, or you can go up the mountain and where it's a small river and change one little rock or two or three little rocks or dam it up very easily and change the direction, and it will change everything. Now, one of the things that chaos teaches us is that Newton's laws of motions don't apply universally. They apply to man-made things, but not universally. And they have a thing they call the butterfly effect, which is simply that this little monarch butterfly somewhere in South America is flying around looking for some pollen, and he sees a little flower over here, and as he's going over there, he sees a better flower over here, changes his mind, that's a fractal, and he flies over here. Now that sets up a little air current, and that air current sets up another air current that sets up another air current that keeps the high level winds off of the Antarctic, which causes an El Nino, which causes a drought next year in the bean belt, and we're going to have beans in the team because that little monarch butterfly changed his mind there. Now this is kind of ridiculous, but the point is that the cause and the effects are not equal, that the effects can be all out of proportion to what the causes are. Let me give you another example. Let's say that right now you were hit by a sudden urge to go to the bathroom, and you had to get up and go to the bathroom. You would probably get up wherever you are and squeeze by somebody and go out the door and go that way and then turn left or right. The bathroom is really over there, isn't it? But the most direct approach. But in your life experiences, you've learned that it's not too healthy to bump into too many walls. So your behavior is going to be changed. Now, as you're going to the bathroom, you probably are not going to be aware that your behavior is mightily influenced by the architect who drew these plans and the builder who built the building. You're just going to go to the bathroom. So your behavior is determined by the always underlying and usually unseen behavior. Same thing is true with the market. Now the third principle, which is our savior, is that this unseen behavior or this unseen structure, underlying unseen structure, can be discovered and it can be changed. So you can change the river one of two ways. You can change the riverbed, or you can change what's going on. Let me give you another example. Let's do an experiment here. And by the way, any of you here who don't have these pages? Everybody get 2 pages? Okay, take one of these pages. We're going to do an experiment. And what I'd like for you to do, this is a game. And the name of the game, these are random numbers. And up here on the screen, you can see that, let me get a pointer here. Yeah, great. If you don't have 2 of these sheets, take 2. And we need 2. We're only going to use 1. But number 1 is up here in the far left-hand corner. What we're going to play is a trading game. And the way we're going to determine how successful you are is how high you can go in the numbers. So what we're going to do in a moment, don't do it yet. We're going to put our pin there, and then we're going to move it over here to number 2, and then we're going to look for 3, and these are the number of successful trades you've been able to do. So the higher your number, the more profitable trader you are. And I'm going to time you, and your job is to go from one to the other as fast as you can when I say go. Okay? Put your pencil on 1 and go. There are no losers, it's just how many winners you can get. 3, 2, 1, stop. Okay, let me ask you, how many of you made it to 15 or greater? May I see your hands? Anybody make it to 1 to 15? Great. Star trader. Give him the crown over here. How many got 10 or more? Okay, good. How many got 5 or more? Okay, now let's do another little look at this, and what I'd like for you to do is take the blank sheet you have, not the one you have marked up, but the second sheet you have, and fold it this way. Fold it long ways, if you would, and then just crease it down the middle. And after you've creased it down the middle well, so that you have a center line, open it up again, and just look at that. And what do you notice about the 2 sides of the paper? Anything interesting? Yes. All the odd numbers are on one side and all the even numbers are on the other side. Now what does that tell you? That tells you that for every time you go from one number to another, you're going to have to cross the center line. So all of a sudden, just by knowing this tiny, tiny bit about the underlying structure, it gives you direction for your behavior. It means that when you hit 1 over here and then go to 2, you can eliminate all of these choices. All of these are going to be bad trades. Your next good trade is going to be over here. And then when you make that one, your next good trade is going to be over here. Now, take the sheet again this way and fold it the other way so that you're creating 4 quarters in it. Okay, now, I will tell you the answer to this one because this is a little bit more subtle substructure. But if you look at it, you'll notice that the first 6 numbers, 1 through 6, are on the top half. 12 through 18 are on the bottom half. 19 through 24 is on the top. 25 through whatever, 30 is on the bottom. So every half dozen numbers, you're going to have to cross this line. So when you go from 1 to 2, you know not only that 3 is going to be over here, but 3 is going to be in the top half. So now you have eliminated 3/4 of the static here. Because you know that 3 is going to be there. You know that 4 is going to be there, 5 is going to be there, 6 is going to be there, and 7 is going to be down here someplace, 8 is going to be there, 9, 10, 11, 12, and then 13 is going to be up there someplace. And that's all. Now, what I'm going to do is we're going to ask you to repeat this, except this time I'm going to take 1/3 of the time off because you've had a little practice. So we're going to take 1/3 of the time off to eliminate the practice you had, and put your pencil on 1, and when I say go, let's go again. Okay, ready, go. Five, 4, 3, 2, 1, 0, stop. Okay, how many of you now, we had one that got past 15. What was your number first, your first number?
I did not follow the rules.
Oh, okay. Well, all right. The FBI sting's going to be after you soon. How many got more than 15? Anybody get more than 15? Okay, how many got more than 10? Let me ask you this question. How many of you got twice as many as you did the first go? Okay, look at this. About 90% did twice as much in 2/3 of the time, and who said 3 times? You got 3 times as much. Okay. And 15? Great. In 2/3 of the time. So we've cut the time down to eliminate the practice effect, and yet just knowing that little bit about the underlying structure gives you a tremendous advantage. Same thing is exactly true in trading. Now, let's talk about what a fractal looks like in trading. And on page 9, GG9, we have a series of different kind of fractals. Now, what we did, how we actually arrived at this, we did not arrive at this through pattern recognition. We arrived at this by mortgaging our house and our body and our soul and our firstborn kid to a couple of theoretical PhDs in math. Now, I don't know if you've ever dealt with theoretical PhD or PhDs in theoretical math or not, but their brains are made of platinum. It's not this curly stuff we call the cortex, it's platinum. And they will only work in pairs, Bob, and they only work at home, and they don't want any supervision. So we would get on the fax line, for example, we'd get a little fax in the morning with about a half of one line there with a formula, and they would say, man, we worked on this 3 hours last night, you owe us $3,000, please wire the money. And I don't know what this means, and I don't know what I'm going to do with it. Well, we went through this for years, and finally they had it out. What we did is we asked them to take, for example, the entire bonds from the inception of bond trading, and take the whatever bonds did while they were trading, take the whole length of it, and figure out what the fractal was. And guess what the fractal was? Very, very close to 3 decimal places to the Mississippi River. So the bonds are much more like the Mississippi River than they are any kind of intelligence. If you want to know what the market really, how it behaves, we ought to take this pitcher of water out there and pour it on the ground and watch it run downhill, because that's the way the market behaves. Then what we asked him to do was to take these sequences and put it up into little bits here, and then overlay it 1/3 by 1/3 by 1/3. Then if this number is x0 and this number is x1, if this is different from that by certain percentages, we wanted an asterisk. Then we said, go back and do it for this many back here, and for lack of imagination of anything better to do, what we did is we used the Fibonacci numbers, 3, 5, 8, that sort of thing. And if it varies from there, we want 2 asterisks. So what we ended up with, literally, was file cabinets full of computer papers with open, high, low, close, timestamps. Every now and then you'd have an asterisk, and every now and then you'd have 2 asterisks. Then we went back, and this took years, and looked at trying to figure out a pattern that was consistent with what the computer had found. And these are the patterns that we found. And it's very simply this. We first call this the 5-fingered boogie. When I was in undergraduate school, I made part of my tuition, good part of my tuition, playing in a Dixieland band. And we had a number that featured the piano player called the 5-fingered boogie. And because it requires a minimum of 5 bars. Now what happens is simply this. The market is going up, as evidenced by the highs. And all we're talking about now is the highs. We don't care about the open, high, low, close, just the highs. But anytime you have a minimum sequence of 5 bars, where you have 1 bar that has 2 preceding highs, 2 preceding lower highs, followed by 2 following lower highs, you have a fractal. Now, when you have a fractal in one direction and it's followed by a fractal in the other direction, what you have always, 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 always is an Elliott wave of 1 degree or another. Now, the next thing is that this is a pristine fractal right here. If I get in your way, holler. This is a pristine fractal here. If you have a fractal whose middle finger is parallel, then if it's parallel to the top, the second one doesn't count. If it's parallel down here, both of them count. The definition is very sloppy. The technical definition is it's a minimum of 5 consecutive bars where you have one of the bars that has a higher high than 2 preceding bars and higher than the 2 following bars. Now, the 2 preceding bars and 2 following bars do not have to have this angle. So you can have this kind of configuration here, and it's still a fractal. This is still a fractal, and these are your down fractals. Now, the next thing that comes into effect is that a fractal is always a fractal. Whenever you have a fractal, it's a fractal, it's a fractal. It's like the old Dr. Seuss books, a hump is a hump is a hump. Remember the old 7-wump hump? Once it's a fractal, it's always a fractal. Now, a fractal will change, though, in its behavior depending upon 3 things. And that's where it depends upon where it is. If you have a fractal that's up, this is an up fractal, meaning the middle finger is pointing up, followed by a down fractal, we call this first fractal a start. We call this fractal a signal. And then if the market comes up and goes past the signal, that's telling us to be short. So we have a fractal up here, a fractal comes down here, and it comes up here. Now I'm going to use lines, but what you saw was the bars. Then this becomes the start, and the second one becomes the signal. Then what this tells you here is that the market came down that far, changed its mind, creating a fractal, and now it's going up. If the market turns around and goes down, the market is then telling you to be short. Then you're going along with the market. You're not trying to buck the market. And of course, one of the things that you hear all the time, that the way to make money in the market is to buy low, sell high. You also hear the only way to make money is to follow the trend, isn't it? Well, you can't do both of those. I mean, if you're buying low, you're bucking the trend. So what Tom was talking about at lunch is he's bucking the trend. And this is not good or bad or indifferent. It's the way he makes money. There are hundreds of ways to make money in the market. Making a profit in the market is very, very simple. Now, notice I did not say easy. I said simple. There's a big difference between the two, between being simple and being easy. If you read Jack Swigger's book on the Market Wizards, you find that there are many different ways to make money. An interesting observation is that there's only 2 ways to lose money. So if you're a new trader, I would suggest you concentrate on the ways not to lose money as opposed to the ways of making money. The only two ways not to lose money is inaccurate analysis or inaccurate implementation of that analysis. So the only way to lose money, or the way to keep from losing money, is to know what to do and do what you know, kind of thing. If you know what to do and do what you know, you're going to be a winner. Now, let's look at the Elliott wave. In the Elliott wave, you only have, in the whole market, you only have two fractals. That's an up fractal. Let's call that A. This is a down fractal. Let's call that B. Now, the key thing here, the real key thing, is that you must have leverage here. This left leg, and we're always reading from right to left, this left leg must always be longer than this leg. Coming down, this leg must be longer than this leg. An easy way to remember it is just to put your left hand up and put 3 fingers down. And from your point of view, and remember in the pitch, when your palm is away, that's selling. When your palm is back, that's buying. This is a sell fractal. That's a buy fractal. That's all it is. Sell, buy, sell, buy, sell, buy. If you put 3 of these together, let's say that you put an A plus an A plus an A, what you get is an impulsive 5-wave Elliott move. You get this plus this plus this. If you put a B plus an A together, what you get is a 3-wave correction. So the underlying structure of the market, in my opinion, is the Elliott wave. The underlying structure of the Elliott wave, I believe absolutely, and will stake my life on it, is the fractal. Here's another view of the fractal on the following page, which is page 10. And a fractal, a 5-fingered boogie, and a hump are all the same thing. Now, we overcomplicated it terribly. It's really not that complicated. But you have a fractal up, and it's followed by a fractal down. That's a signal. A fractal down followed by a fractal up is a buy signal. Now, if this market comes up here and goes beyond the start, then that negates this signal. You would not sell here. Because it says, what this is telling you, it made an up move, then it changed its mind, made a down move, then it changed its mind again and made an up move there, because it's following the path of least resistance. Any questions at this point? Does this sort of help you understand what a fractal is better?
What would be another word for that?
The question is, what would another word be for the fractal? A fractal, in some people's terminology, is a trend change. It's a Joe Ross calls it a hook, or what he calls a hook is a fractal. What Kent Calhoun calls 5 vertical bar change is a fractal, although we look at it in a very different way, and our signals are very different from that. But a change in trend, a swing top, swing bottom, those are all fractals. The end of every Elliott wave is a fractal. The end of every corrective wave is a fractal. And one of the characteristics of a fractal is it contains a thing that the science of chaos calls self-similarity. Now, all self-similarity means is it has to work in all time frames. So if you have a fractal trading system that works on a 5-minute bar but won't work on a monthly, it's not a fractal. In looking at the Mississippi River, for example, if you take a fractal analysis of the Mississippi River from a satellite, you're going to have a fractal number of 1.2610. If you take it from 100 feet up, it's going to be 1.2610. If you take it from 6 feet up, it's going to be 1.610. If you take it from 2 inches up, it's going to be 1.2610. It's always the same. If it isn't the same, if it doesn't work on all time frames, it's not a fractal. Now, let's look at the market a little bit. Let's look on your page. Yes? Yes, we have. We do. The question is, have we ever tried to overlay it with volume? Yes, we do a thing, and let me just, without getting too far off base, the two things that are critical in the market, and you know, a lot of people complain today, a lot of the old traders complain today, us old traders complain today, that the market, making money in the markets were a lot easier in the old days, and it was. I mean, if you were halfway awake in the 60s and 70s, you could make money in the market. And as Tom pointed out at noon, that's because we were in a highly inflationary thing, and you just buy, that's it. Markets aren't like that anymore. And what most people say is that the markets aren't like that because now we have fewer retail people, and we have all of these big, bad institutions that are running the market. Well, that's really so much BS. I mean, I hope there are more of these people. You know, there are almost 3 times as many mutual funds as there are stocks on the New York Stock Exchange. I heard the other day that there's an average of 3 to 4 new mutual funds that come into existence every day. Well, that's great. And the reason that's great is because these guys are dinosaurs. I mean, if you're in there and you're trading a $500,000 account or $1 million account, you've got a flexibility that somebody with a $20 million account can't approach. So these guys are dinosaurs. Now, what I want to be the little cockroach that just lives on the leavings of these guys, you know, and I'll survive evolution because I can get in and get out. And I don't have to have all of this thing. Now, if every time the bonds went up 1 tick or down 1 tick, that was $62,000 more or less in my account as it was in Larry's, I would be dinosaur-like too. I mean, I would sort of freeze up, I think. But what we do, Bob, is we take the range over the volume and come out with what we call an MFI, which is a speed indicator. And from that, and comparing that to the volume, because what we do have today, since the market makers are no longer on the floor, anytime you have an increase in volume, you have an increase in outside paper coming in. Anytime you have a decrease, you have the opposite. And prices are the last thing in the world to change. What changes before price is momentum. What changes before momentum is volume. What changes before volume is millions of crazy traders like you and I out there making these decisions. So what we want to do is back up on this decision line and get the fractals there, because our brain works like a fractal. Our brain is a fractal. And that's why I think that you need to trade your belief system, because that's what the markets are. The markets are an anticipatory market. You don't buy and sell current value. If you go out here to buy a used car, you buy current value. The markets are very simple. Let me tell you how simple the markets are. The markets are nothing in the world designed to do anything except find that specific point where there's an equal disagreement on value and an agreement on price. And let's use a Flintstone example that I kind of like. You know, there are 2 guys in Flintstones, Fred and Barney. Fred's an outdoor guy. He goes out and he kills dinosaurs and this sort of thing. Barney is more a stay-at-home guy, and he likes to sit in the backyard and whittle on wood and stuff. Barney goes out and he kills himself a dinosaur. He comes in and he's got all these dinosaur whoppers here. And he goes over to Fred's house and he sees Fred has carved out this new club over here. And he says, Fred, I'll make you a deal. I'll give you 2 platters of dinosaur burgers for that new club. And Fred says, man, if I got 2 platters of dinosaur burgers, I don't have to go dinosaur hunting for a couple of weeks. Yeah, you got a deal. So they swap. They have created a commodity market. Now, there is no market in the world, IMM, CBOT, CC, there's no commodity in the world that's more complicated than that. The last time you bought a car, you had a certain amount of money. That car was more important to you than that money. That money was more important to the guy who had the car than that. So you swapped money and car. You created a commodity market. Now, if that's true, then there ain't no such thing as bullish and bearish consensus. There ain't no such thing as oversold, overbought. There can't be. The markets are specifically designed so that there can never be oversold, overbought. As we said earlier, oversold, overbought simply means it's higher than I thought it was going to be. But the markets are exactly where they're supposed to be because they have found that equilibrium where there's an equal disagreement among value and an agreement on price. Okay, let's look then at this page, and here it is, page 11. And by the way, these are actual trades. There's no hypothetical stuff in here at all. I don't believe in that. This is soybeans last summer. And we trade multiple contracts, but I think the only way to judge a trading technique is really on a 1-contract basis. This was between June 28th and August 2nd of last year. 1, 2, 3, 4, 5, a little over 5 weeks, taking 1 contract on every fractal. Now, what you see in your notes where it says long at 628, that's where we took the trade. The fractal is to the left of that. Now, here's another fractal. This is the next fractal up. So we went long at 661. And my memory was there's about a half a cent or a quarter of a cent slippage on that one. We had another fractal up here, and then look what happened. It opened gap up, didn't it? So the fractal signal here was about 675, but we went long, 50, 60, 70. Yeah, about 675. but we went long at 688 on the open and got a half-cent slippage on that. And then we went long here and we went long here. Now, see this area right up there where that's circling, where the laser is circling. Is that a fractal down or not? Somebody tell me. Why is it not? So I see some shaking heads. Good. Why is it not a fractal? Right there. Because it doesn't have two higher lows to the left, does it? It only has one. So that's not a fractal. It's not a signal. So that one you don't go down. This one right here is a fractal. You have that one, that one, that one. The two following are higher lows, but it didn't go below that. This one is a fractal up, so we went long here at 711, just before the gap. This happens all the time. By the way, you probably know that almost all gaps either happen in the third wave or a C wave. The fractals will oftentimes, and oftentimes 70 to 80% of the time, will get you in toward the close of the day before a next day fractal or next day gap open up. It did not on this day, but it did on that day. Then we come up here. That's also not a fractal, is it? For the same reason, that wasn't a fractal, because you don't have the 5 bars there. But we reversed and went short here and went short here. The results of that 5 weeks of trading, just on a one contract basis, was 347 points. The maximum margin that we needed from our account was $4,860. The profits took care of all the rest of the margin. So the maximum margin we had was $4,806. No, 4,860. On the next page, on page 12, I want to show you May the 19th of last year was our very best day of trading the S&P on a 5-minute basis, and we usually trade the S&P on a 5-minute basis, except around noon when it goes down. We like to trade the shortest time frame we can in day trading that gives us an average of 20 ticks or more. That seems to be a crucial thing. If you go less than 20 ticks, then the locals on the S&P pit have an opportunity to run your stops. Here is, and this was our best day this year, which was February the 4th. Notice that it opens up here. This is the opening at 8:30 Chicago time. We had a fractal down here. We did not take this short because 2 of those legs in that 5-legged fractal were made the afternoon before. So that you can choose to do that, but normally I like the fractals to all be made in consistent or consecutive time frames. We had a fractal up here, and these carrots, by the way, are denote where your fractals are. But this was not a buy, and the reason it was not a buy is because the start is here, the signal is there, and the price came below the start, so that negated the buy. Any questions about that? You've got to have this or this or this. The thumb has to be shorter than the forefinger. So we came up here. This is a legitimate buy because the leverage goes back to here, but it was never taken out. Then this is the legitimate sell. Now at this point we had a buy stop 1 tick above there, and now we have this. So we have a sell stop 1 tick below there. So we have a bracketed market. If we get in, whichever one is not taken is a stop for the other. So our first sell was here at 480.55. And notice that this is 1.5 hours after the market opened. So the first hour and a half, there was 2 signals, but nothing that was triggered. So we didn't go in on the first contract until an hour and a half after the market was open. Then we came down here. We have a fractal down here. The leverage goes back to there. It's a legitimate sell. We have a fractal up here. The leverage goes to there. A legitimate buy, but it never was taken. This one came down and came back up, and this one was taken, and we took one based on this one because its leverage was still intact. So we sold the second contract here at about a little before noon, and the third contract a little before noon, and the fourth contract about 12:30. So around 12:30, after the market had been open 4 hours, we're now short 4 contracts. If you would turn over to the next page, and this is page 13, and remember that we're at about 12:30, so we're already into this one. Then it comes down, we get an up fractal here, but it's taken out, and the market never gets up there anyway. We add here, we add here, we add here, we add here, and notice after this fractal, and this happens over and over again, once it takes out a couple of fractals in a row, it goes down here, and then the next fractal is there. If you would please turn over to the next page, and then our last entry was here not too long before the market closes. Now, normally, we don't take, I don't like to take an entry position in the S&P during the last hour. If we're in, I like to manage it out. But since things were going so well, and since we were obviously on this and we had no up fractals, then we took this one. And then on the next page, it gives you the results. And here are the results. There was a total of 9 contracts, and this was the results minus this. I'm sorry, this is 1, 2, 3, 4, 5, 6, 7, 8, 9. This is wrong. There were 9 commissions there. We were short 9 contracts with that kind of profit, which by my standards is quite a good day. Any questions at this point? Okay, let me show you then how we work that in with the Elliott wave. Now, let me just show you this for a second. This is page 25, and I'm not going to take much time because this is pretty self-explanatory. If you go through this flow chart or decision format, I think it will help you a great deal at defining where you are in the Elliott wave. When you come to our tutorial, we guarantee you that by the afternoon of the second day of the tutorial, we guarantee you that you will count the Elliott wave better than the guys in Gainesville, Georgia do. Most people say, you know, the old saying, you can take 2 Ellioticians, put them in a room with one chart, and they'll come out with 9 different counts. It doesn't have to be true at all. If you understand the underlying structure and the fractals and the momentum, you can always get it down to one of 2 alternatives, and whenever you get it down to one of 2 alternatives, there's obvious trading strategy whichever way it goes. So I just want to make mention of that. I think these pages are very important, and I think our time can be spent a little bit better doing something else here. And what I want to do is show you how we count the Elliott wave. This is the way we count it. And I said at noon that we look at the market very simple. We have what we call a 10-second analysis. In the tutorials, we kind of hassle you a little bit. We throw new charts at you. We give you 60 seconds to analyze a chart and know what your position should be on every one of these. This is page 29. What we use is a 5-34-5 MACD. And all that is a 5-bar simple average, moving average, and we haven't found it makes much difference between the open, high, low, close. What we normally use is high over low divided by 2. We use the midpoint. Again, for lack of imagination of anything better to do. So you have a 5-bar moving average, and you subtract from that a 34-bar moving average. So when you get on an impulse wave, like the third wave, that 5-bar is going to go up much faster than the 34-bar is, and that's going to give you a difference in the oscillator. Now, an oscillator is simply one moving average subtracted from another moving average, and it always is a lagging indicator. The oscillator here is the histogram. So that histogram right there, that's the oscillator. Every one of those points is a 5-bar moving average subtracted from a 34-bar moving average. And so what you see, it peaks on the third wave. Then, to make it into a MACD, you take a 5-bar, and all of these are very, very simple, no complex exponential or anything else. You take a 5-bar moving average of that oscillator, and that gives you this line here. And that's your momentum line. Now, there are 4 things that are absolutely invaluable that you can get from this. And this should be worth a fortune to you. If you're going to trade, this in 35, this is we're into our 35th year of trading, is the most valuable oscillator, a valuable indicator I've ever seen in my life. I've never seen anything, anywhere, anytime that can even approach it. And when you put it together as a MACD, it no longer is a lagging indicator, it becomes a leading indicator. However, there is one caveat here, and listen very carefully. It's very simple. And let me put it in very emphatic and simplistic kind of terms. The requirement that you must have for this to be accurate is that you, on the wave count that you're analyzing, not on the chart. It has nothing to do with the number of bars on the chart. On the wave count that you're analyzing must contain between 100 and 140 bars. Okay? And remember, this is the wave count you're analyzing. This is not, this happens to be a CQG chart, and just by happen chance, CQG have 140 bars. So this whole chart has 140 bars. Now, on Ensign, on I think on Metastock, on First Alert, on Aspen, on TradeStation, all of those you can vary that number. The reason for that is that your lagging indicator here is 34 bars, and 3 standard deviations would be 3 times that, so that'd make it 102. So you must have 100 bars. Now, in this illustration here, wave 1 through 5, and this comes from June and July bonds of this year, only had 65 bars. So the oscillator doesn't work. Now, it works a little bit, but it doesn't tell you accurate information. It tells you the peak is there. And I'll show you on the next chart, on the next page, where 85% of all Elliott wave errors occur. On the next, Tom had access to a Cray mainframe, and we were averaging the MFIs for each one. And Tom put over 3,000 different charts through this and came up with a 535 oscillator. Well, I scavenged that, but I was uncomfortable with that because 34 is a Fibonacci number, and I didn't want to upset the voodoo gods, so I used 534. I see no difference between 534. I've never found any difference between 534 and 535. And then we added the 5. Do what? You use 1334. Those are fib numbers. I find the fib numbers are incredible. I really do. I like fib numbers. I also very much, we don't have time today, but we've gone much, much deeper into the fractal. And one of the things that you can play around with is we've found out a way to measure the distance, the power distance between strange attractors. And it comes out to be a 13-bar moving average displaced 13 bars in the future. And we'll talk about that sometime. That becomes lethal. Okay, here we are. We're ready to trade this. We think because it's got a double divergence here, we think it's going to go down. We may be short. We want to stop in reverse, or if we're not in, we want to get short. So to get this more precise, maybe what we ought to do is just look at this 5th wave by itself. So what we have to do to look at the 5th wave, now we're on a 30-minute bar, and this looks like it takes, what, about a third of the chart, right? So to get this to 100 bars, if this is a 30-minute bar, what would we go down to? We want 3 times the number of bars. 10. Okay, so we put a 10-minute chart up there, same to see what's inside of wave 5. Here's your 10-minute chart. And what you get is exactly the same thing. And the reason I brought this was because this is a good illustration of how almost infallible and how accurate it is. This has to be wave 3 here because the peak. Now notice that 5 bar is only plus 854. This is 859. That's only 5/100ths of a point difference. But that difference is important. It's significant because that says that there is divergence between here. And also notice that this is wave 3. Well, let's go back here. This is wave 1, wave 2, peak of wave 3. The minimum requirements for wave 4 have been met, came down here. And then look at this peak. This is wave 3 here. And this is 4, and this is 5 up here. So this is 1, 2, 3, 4, 5. And if you wanted to get in here on this last wave 5 of wave 5 of wave 5, you can do the same thing. So you can pinpoint it down more and more and more. Here, for example, let me, Mark, how much time do we have? Okay, let me show you, let me take you down from a high one. Here is gold. Gold has been very, very nice to us over the past few years, but gold has been treacherous for a lot of traders to trade. You don't know, it doesn't matter what chart this is. Absolutely, it does not make any difference. Same kind of interpretation. Yeah, taking it down to a 1 minute. Yeah, to get that. We often do that. And it holds up. Incredibly, it holds up. Now, the more volume you have, the more accurate it's going to be, obviously. But you can... Yes. Yes, the question was, if you overlay it with volume, you can see the fractals, and you can see inside the fractals, the squats and the greens and that sort of thing. And if you have a TradeStation, you can even program that so that it will color the bars differently. And if any of you have TradeStation and want some of those programs, leave your name and address with us, and we'll mail. In fact, I think we have no, we don't have any here. We're out of those. But I'll mail you a disc that you can just transfer it down. But in the gold, the first thing you look at is this. This tells you that the peak of gold for wave 3 was back in 87. So this had to have been 1, 2, 3, and look at this, 1, 2, 3, 4, 5. We've been in a wave 4 for gold on a monthly basis for 5 years now. And gold has not been that good at trading for position traders, or a lot of position traders complained about gold. But down in here now, we're starting something new. So what we want to do now is go to a weekly. So let's take that gold and let's go from the monthly and let's go down to the weekly. And remember that this area here is the end of wave 4. If that's the end of wave 4, what is this? It's the peak. It's got to be wave 3. So coming up here to wave 3, we can count backwards. This has to be 1, 2, 3. Inside of 3, there's 1, 2, 3, 4, 5. Here's an A, B, C, 4. And although we don't have enough to really accurately and infallibly count it right now, we can make some suppositions that this is 1, 2, 3. And most of your fourth waves look like this. This was a very unusual fourth wave. Anytime you don't know where in the heck you are, you're probably in a fourth wave. Fourth waves are bastards to trade for most people. 85% of your whiplashes will happen in there. So let's say we don't trade the weeklies. We want to go down from that, and we want to look at the dailies. So we'll take that same thing and look at the dailies. And when we look at the dailies, what we find is a lot of confusion. And the confusion is because we're still into wave 4. So we'll go down here and we'll look at this. So let's go down to the next unit. And if you're confused, it's good to go down, and we'll see if we can get any trading information. Now we're working on something. Now we've got some kind of a move. And as we were talking about in lunch, that most of the moves take up the minority of time. The majority of time takes up in a bracketed market. So here we have what? A wave 3, don't we? If that's a wave 3 up in here, then this must be a 1, 2, a 1, 2, and where do gaps happen? Wave 3s most of the time. So this is 4, and this we don't know what this is. Now this was through Monday of this week, 9/26. On Monday we went long down in here, and we were still long when we left to come here. We put our goals in there, our projected goals, which is an Elliott wave formulation. You take the distance from the beginning of 1 to 3, and then you add that to the bottom of 4 and take 62% of it, and then that's your target zone. Our target zone was calculated to be between 4 and 402. So we knew, since we were long from here, we wanted to get out and reverse somewhere up in this area and go short. So going Bob down to smaller and smaller time frames, we went from a 60 minutes to a 30 minutes to see inside of this wave 3. So we have 1, 2, 3, 4, 5, and here we go. Look at this. We have a top of a wave 3, but it doesn't go to 0. It comes back and has a divergence. So that means that that point there is what? That's 5 of 3. And the point here is 3 of 3, because this did not go back to 0. Since this went to 0, that tells us that that indeed is 4. And one of the targeted places for 4 to end up is equal to the bottom of the fourth wave of the previous count, which is 1, 2, 3, 4. And look what it did. Almost to the tick across there. So now what we want to do is to get more and more precise with this. So now we want to look at this little fifth wave up here, and look at this. 1, 2, 3, A, B, gap. Where's the gap? In C. What wave is C? C is the third wave, isn't it? Most of your gap. Now this is not true in currency all the time, because there's so much activity in the overseas market in currencies. But soybeans, grains, gold, things like that are not more heavily traded overseas than here, this is lethal. So again, we still have our target from here to here. We know we're not over because we don't have any divergence down here. We don't have a higher high with a divergence here. If we did, we'd already be selling. So then we come down from a 30-minute chart. Let's go to a 10-minute chart to see if this really carries out. Remember that chaos says and fractal says it's got to be true on everything or it's not true on anything. So here we have a third wave on the 10-minute. 1, 2, 3. Inside of 3 we have 1, 2, 3. Where's our gap? 3. There's your third wave, 4, 5, A, B, and then you can see this even clearer. 1, 2, gap 3. So at this point, and this is the point we left, we were expecting it to go down even further. So we had our stop down here at 397.30, I believe it was. But we were expecting this to come down because this 5-wave sequence, and all C waves are 5 waves, wasn't over. So one day this week, my calendar's gone right now, but When was it? Wednesday or Thursday that we had the $3.50 fall in gold? That was Wednesday. Anybody remember exactly? But it was down $3.50. Well, what that did is that completed that wave down there. So then we expected the next move to go up somewhere to our original target, 400 to 402. And what did it top out at? 402, yeah, I think it was 402.50, someone told me. I haven't even seen it. But if we want to go even further down, let's go to a 5-minute chart. This is the same fifth wave here. Well, that's the same chart we just looked at, isn't it? Yes. Okay, let's go down then. And Bob, this answers your question, I think. Can you go all the way down? This is a 1-minute chart. Now remember, we're on wave 4, but we want some good infallible knowledge of where we are. So we don't have quite enough bars here, but a CQG will not give me a 20-second bar, unfortunately. I'm not sure you could do anything much with it, but look what you have. A 1, 2, gap 3. This has all the characteristics for a 4, came down into here, then it went back up to here, and now it's a short. And hopefully you're short gold. And if what Larry is saying about buy the S&P on Monday, and the bonds are probably going to go up, and bonds and gold usually go different ways, so what would you expect gold to do? So if you're going to buy the S&P and the bonds on Monday, you probably also ought to sell gold, and probably ought to sell silver. We'll see if that works out. And I haven't seen a chart since we left, so I want to look at the charts when we get back tomorrow, but our prejudice right now is to be short the gold. And we already have reverse, so we're looking for it to come on down. Any questions at this point? Okay, now let's do, let me share with you some things that really are the underpinning of our trading, and this is spreads and selling options. And spreads are so simple, it's almost like collecting rent. Remember that there are only 2 fractals, right? There's a fractal up that goes like this, and there's a fractal down that goes like this. And remember that you have to have leverage. So if you have a move like this, and in spreads, obviously you don't get the open, high, low, close, you only get the close. So all of your spread charts are going to be lines, they're not going to be bars. So this would be your buy stop. So you would buy here. If it comes down here and goes back up, you would buy there. Your stop would be 2 fractals back in the opposite direction. Or if you get a sell signal, you would stop and reverse there. Very, very simple, no-brainer, no counting waves, nothing of this sort. Just following the fractals. And remember, the fractals are the underlying structure of the market. Okay, let's see what it did. On page 33 of your notes, this is from last year's trading. Trading the Swiss franc and the D-mark, and oftentimes people will say, well, those are 2 of the same things. They don't really, they travel together. Don't you believe it? Some of the best trading in the world is trading currency spreads. The only thing that trends more than currencies are currency spreads. They're more trending market than currencies. And the Swiss franc D-mark is one of my favorites because it has a high degree of winners, very, very low drawdown. You make more money with Swiss franc Japanese yen, and you have more drawdown. So here we go. This is August of last year. We have a fractal here we bought, fractal here we bought, fractal down here we sell, fractal here we stop and reverse, fractal here down, sell, 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 another sell, 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 stop and reverse, buy, buy, buy. So in a period of 1, 2, 3, 4, almost 5 months, we ended up with 29 straight winners. Now, I don't know about you, but I don't often have 29 straight winners. I'd like to, but it just doesn't work out that way. No losers, not a single loser in the 29. Then on another page, we have the current trading, and this is from June the 16th until 8/15. And by the way, the thing that I like about this too is oftentimes you know it's going to be at least 3 days before you get a signal. So you don't have to watch the market. You can trade the currency spreads literally, very easily by devoting 10 minutes a week to it. And the income you get from that makes you worth what a theoretical math PhD is worth, or what they think they're worth. But here we have the same, the Swiss franc D-mark, and we're long here, and these little carrots are fractals. That's a fractal. We're long here, long here. We went long there. We also went long. We had a after this, where was it? We went long here at 12.23. We went long here again at 12.83. Then we had another signal up here where we had a 23-point slippage, where the signal number was, it went up overnight and went up, and now we were out because we had 2 fractals back, and since then we've gone short. So currently we're short from 13.53, a difference of 13.53, and the market closed yesterday at 13.32 or 13.33. So we have 20 points on the downside now in our first foray into this short. Any questions how this trades? Okay. Yes, we're short the franc, long the D mark right now.
When did you reverse that?
That was either, I'm not sure if it was yesterday or Thursday, but if you look back on the chart, it'll be obvious because we left that in. And Chris is not here. Our Chris Camberas is our broker who came here with us today, and he would know. I don't know. But here is the, I don't know for sure, here is the Swiss franc yen trade for the same period last year, those 5 months. And notice that there was one break-even trade here, and there were 2 losers. There was a 46-point loser and a 15-point loser. So the total combined loss was a little over $700 a contract, and the total combined gain for those 5 months was $55,000, again, on trading on a one-contract basis. 1 contract for every trade. And then this year, just to show you that the Swiss franc Swiss franc yen is more volatile, you'll make more money, but the reason for that is the currencies are not the same. The yen is the most politically motivated currency. The mark is the most industrial connected currency, so when you have capacity utilization, those kind of things, the mark's going to respond more. And the Swiss franc, which is the only major currency backed by gold, is the most speculative currency. So, and that's why the Swiss franc will always go more closely to gold than the other 2. But there's plenty of difference without being too risky to trade the Swiss franc yen or the franc D mark. Now notice on here, and you put the orders in by the spread. You don't care what the prices are. You just say I want to buy it at a spread of minus 27.67. And here we had 9 winners and 4 losers, but we had more profit in there. Now, what we've gone over very rapidly is to give you a kind of a preview or a overview of fractal trading. And our belief, our deepest belief, is that nobody trades the market. We all trade our belief system. So what I want to do is I want to get my belief system really out of the way. I want somebody to form an opinionectomy. I don't want any opinions. I don't want any predictions. I don't want any fortune telling. We've got some fortune tellers in around Alabama, for example. If you came to visit us and I said, hey, we're going to trade bonds, but before we do trade bonds Monday, let's go visit this fortune teller and have her read the palms and tell us where to buy or sell. There's no difference between that than anybody who predicts the market. Whether it's a newsletter, whether it's a fax line or a hotline, anybody who predicts what the market is going to do is a fortune teller. Now, you would think I was silly to go to a palm reader because we do that for fun. But if you read somebody's projection, nobody in the whole world knows where bonds are going to do, what bonds are going to do Monday. There may be some more probability in one direction or another. We may anticipate it, but trading predictions is not the way we have found to make money in the market. Remember the old Flip Wilson, the comedian, who used to have the church of what's happening now? Well, what we try to do is trade the market of what's happening now. We want to trade nows as opposed to futures. And we never, ever pay any attention to announcements, this sort of thing. If you know where you are in the Elliott wave, well over 70% of the time, you will be in the direction the market announcement will take you. Only once in the last 6 years have we been caught with a limit move against us, and that was some of the worst trading we've done in the last 5 or 6 years, which was last October and November. And if you remember when the crop report came out and beans and corn and wheat and everything was long, we were short. And that's it. Every other limit move in the past 6 years, we've been in on the side of the limit move. And that's the only time that we've been on the opposite side of the limit move. So I'm willing to keep going into those announcements. I used to just get out all the way. I'd say, man, I don't know what's going to happen, so my best thing is to get out. Okay, we have a couple of minutes for questions. Any questions? If you want to know more, and if you want more information, Our name and address is there. We do, this is a commercial. This is where the bamboo steamers and the Ginsu knives come out. We do, our best thing we do is private commercials, private tutorials where we bring you into our trading room, our trading complex in Mobile, Alabama. We show you everything we have, our proprietary indicators, we show you everything. We send out a 200 to 300 page manual. We like to send that out 2-3 months ahead of time. A set of videotapes, a set of 8 audio cassettes, and 3 computer discs, and that's so that when you come, we're ready to do something. We aren't explaining kindergarten terms. Then after you're there, the tutorial's not over. We feel that if you come, then it sort of becomes our responsibility that you are a successful trader. Our experience has been, I'm very, very happy with our experience. We have trained, it's either just under or just over 400 people in the last 6 or 8 years who are now full-time individual speculators who are making a living trading. After the tutorial is over, that Wednesday, we stay in very, very close touch, either by telephone and or fax, for at least a month or longer if necessary, where we share with you every trade we plan to make before we make it. That has 2 purposes. One is you can take the trades if you wish. In the last 3 years, our worst year, which was last year, our equity was up 125% based on equity, not margin, and we rarely ever margin 50% of the equity. I've never in my life had a margin call. I never intend to have a margin call. I normally don't trade over 50% of my trading equity at one time. The other thing we do is we strongly suggest that when you come, that you come ready to trade your own account on a 1 contract basis. That has 2 purposes. If your money's in the market and we're doing something, you're going to pay attention. I mean, you have a fiduciary arrangement with that market at that point. The second reason for doing that is that gives us a chance to make your tuition back while you're there. Now, obviously, you cannot promise that because that's totally market dependent, but we are able to do that about half the time. Question? Yes, sir. Okay, the question is, if you come to the tutorial and trade your account, do you trade it on a minimum size? We suggest that you trade on a 1 contract basis. You don't have to do that, but we don't want to get messed up where you've got so much winning or losing in the market. The tutorial, the learning is the important thing. So we use the trading as an adjunct of the tutorial rather than using the tutorial to make money. Now, some people do trade more. We've had people there who, come in and out with 20 and 30 contracts of the S&P. As long as that doesn't bother you mentally, that's fine. But we want to keep it low enough so that this is kind of a report card, but it's not the whole goal. Okay, any other questions? Yes? One. I'm saying, the question is it necessary to have real-time quotes with your system? Absolutely not. We've had people come to the tutorial who've never seen a monitor before. We had a guy who owns a string of dairies in Central Florida who absolutely, he says, I'm too old for those damn computers, and I'm never going to have one. And he trades on a longer-term basis. He trades, keeps his own charts, and never looks at anything but the morning paper. We have other people who are, computer junkies, technoids, and this sort of thing who want to trade on a 1 to 5 minute basis. You can't really trade on a 1 minute, but a lot of people into day trading. We've had 8 locals from the S&P pit down. We've learned a great deal from them about short-term trading. But no, you can trade as long as you're, with our technique, or our way of looking at the market, if you're trading on a 60-minute bar or greater, you can go with the delayed. You'd be absolutely foolish to trade the S&P on a 5-minute basis on a delayed basis. If you're going to trade the S&P on a 5-minute basis, your real-time data should be an investment, not a cost. So it should pay off. But yes, we have a lot of people. In fact, we have a trade station there that is on delayed so that people who are trading delayed can see it. Okay. I appreciate you being here. This is the Amen Corner. The thing is almost over. It's been a good 3 days for us. I hope it has for you, and I especially appreciate you being in here this hour. Thank you very much.